when it comes to lending, we have probably, well, I shouldn't say probably, we have the highest quality portfolio of mortgage loans nationwide than we've had in the last 25 years, because all of those guidelines were brought back in. Mm-hmm. And you don't have to, you can get a mortgage with 5% down, or a FHA mortgage with 3.5% down. So it's not like back in the 70s or 60s where you had to have 20% down payment.
So unpack that really quick, right? Because there is a benefit to going one way or the other.
Sure, yeah.
So the 3-5%, you can get a loan. And what type of loan is that?
That's an FHA loan.
And an FHA loan stands for what?
Federal Housing Authority. And originally it was to help people that could not buy a home or had never bought a home any other way. Back in, I think it was 1938. What was that dude's name? Roosevelt, that president. He started it. And because at the time, banks were lending money to buy homes, and they required people to put 20% down. And your average young person getting married couldn't come up with 20% down until a lot of years into their marriage. Mm-hmm. So the FHA came along and said, we can help people get in homes by letting them have a lower down payment. And there's an insurance fund set up by the government.
That's where I was fixing to go.
Yeah, called the FHA Insurance Fund. So in an FHA loan, you're charged a fee up front of 1.75% of your loan amount that's added to your loan. You don't have to pay that in cash. But
is it a one-time fee or recurring?
That part's a one-time fee. But then there's a recurring fee as well.
PMI, right?
Yeah, and in FHA world, they have to do everything different. So it's MIP, Mortgage Insurance Premium.
Okay.
So that.
And how much is that typically?
That has been 0.85% of your loan amount divided by 12 added to your payment, right?
But it's recurring every year, right?
Yes.
Until you hit the 20% mark.
Not on FHA. On FHA, it's there for the life of the loan.
I did not know that.
And it just recently got lowered to 0.55 from 0.85, so it's a little more affordable, because back to what I was saying, the portfolio of mortgages that's out there being paid for now is so much more quality, credit quality, higher credit quality, that there hasn't been near the foreclosures. You look on CNBC or Fox Business or whatever, and they're going to say, oh, my God, the foreclosure rate has gone up. You know, it's like, well, this is what's wrong with 24-hour news cycle. Sorry, I'm going to get in trouble here.
No, I think you're right. They got to make everything a catastrophic event,
right?
Or they wouldn't have anything to report,
and they wouldn't have ratings enough to get advertisers. But they're saying foreclosure rates are really high right now compared to last year, the year before. Guess what?
There was all that stimulus,
and there was a moratorium on foreclosures during COVID.
I totally forgot about that.
You could not foreclose a house, so of course, 3 foreclosures is 300% higher than 2 years ago, because you couldn't have any foreclosures then. So back to the point, though. The FHA Insurance Fund then has a lot of excess money in it right now, because they haven't had to. What happens in a foreclosure of an FHA loan or a conventional loan that has PMI, which is a privately held insurance?
What's PMI stand for, so people?
Private mortgage insurance.
Okay, so all right.
And either one of those insures the lender against you defaulting on the loan.
Okay.
And you pay for it.
Right.
Great deal for you.
Yeah, no kidding. You pay for their own insurance. Make sure you don't default.
Yeah, and if you're a person who's never defaulted, it's a big waste of money.
Yep.
But on either case, if you did default and I had to go foreclose your loan, if I lost money as a bank or a mortgage company, some portion of that loss is paid back to me from those insurance policies.
How much of that?
Well, it's different on every situation.
Give me an average. Give me a range.
22% of the loss. Yeah.
It's paid back?
Yeah.
So I love it. So they put insurance that we have to pay for just to cover the institutions that are making money off of us.
Right. Which